For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. In recent months, technology stocks have faced a storm of challenges, ranging from escalating global tariff disputes and economic uncertainties to an increasingly competitive environment within the artificial intelligence industry. These headwinds have impacted investor sentiment and caused volatility across the tech sector. Despite these obstacles, analysts on Wall Street remain optimistic about select technology companies that continue to demonstrate financial strength, operational excellence, and long-term growth opportunities driven by innovation. Today, we're putting three major players under the microscope: Microsoft, Broadcom, and Palantir Technologies, to determine which one Wall Street considers the most appealing investment right now. We'll start off with Microsoft, one of the most dominant names in global technology. Microsoft's stock has experienced a decline of more than 15% since the beginning of 2025. This downward movement is primarily attributed to broader weakness in the stock market, heightened concerns regarding a slowdown in spending on artificial intelligence initiatives, and the intensifying battle for dominance within the AI industry. Additionally, market reports indicating that Microsoft is putting a pause on its plans to build new data centers globally have sparked concerns about the company's near-term outlook for AI-related infrastructure and demand. On top of that, investors are paying close attention to Microsoft's cloud services segment, especially its Azure platform, as revenue growth appears to be decelerating. This slowdown, when combined with Microsoft's aggressive capital investments in AI and the emergence of more affordable Chinese-developed AI models, has generated further caution among market participants. However, despite these short-term concerns, many analysts remain confident in Microsoft's future. The company's sturdy financial foundation, combined with anticipated growth in Azure as artificial intelligence continues to gain traction, ongoing improvement in profit margins, and the expectation that capital expenditure will eventually normalize, are all seen as powerful tailwinds for the tech giant. In a recent update, analyst Brent Bracelin from Piper Sandler reaffirmed a buy rating on Microsoft's stock and maintained a price target of $520. Following in-depth meetings with company executives, Bracelin highlighted several key factors supporting his bullish stance. These include Microsoft's expansive product ecosystem, the strength of its commercial remaining performance obligation, which saw a year-over-year increase of 34% in the second quarter of 2025, impressive annual operating cash flows exceeding $100 billion, and a scaled artificial intelligence business generating more than $13 billion in revenue with growth in the triple-digit percentage range. Bracelin expressed his belief that these strong fundamentals could help Microsoft navigate the current volatile economic environment that has contributed to recent stock price declines. He views the weakness in Microsoft's share price as a prime opportunity for investors to accumulate shares. In terms of broader sentiment, Wall Street agrees. Based on 32 buy ratings and 3 hold ratings, Microsoft enjoys a strong buy consensus among analysts. The average price target of $510.03 represents a potential upside of approximately 42% from current trading levels, indicating robust confidence in the stock's future performance. Now let's turn our attention to Broadcom, a key player in the semiconductor and infrastructure software space. Broadcom's stock has also faced pressure this year, falling by nearly 37% since January. Nevertheless, Wall Street remains upbeat about Broadcom's prospects, particularly due to the company's focus on application-specific integrated circuits, which are essentially custom-designed processors optimized for artificial intelligence workloads. Broadcom's custom AI chips are instrumental in both training and deploying complex AI models, making them a crucial part of the current AI revolution. In the first quarter of 2025, Broadcom's artificial intelligence revenue surged by 77% year-over-year to reach $4.1 billion. Looking ahead, the company anticipates that this figure will climb to $4.4 billion in the second quarter, further solidifying its position as a key supplier in the AI hardware ecosystem. Back in December of 2024, Broadcom disclosed ambitious plans from its top 3 hyperscale clients, who were expected to deploy 1 million AI chips in interconnected clusters by the year 2027. Broadcom also estimated that the total addressable market for this type of infrastructure could range from $60 billion to $90 billion, suggesting massive growth potential in the years ahead. Additionally, Broadcom has expanded its customer base by collaborating with 4 more clients to help them develop their own unique AI chip solutions tailored to their specific needs. In a move that reflects growing confidence in the company, analyst Louis Michioscia from Daiwa upgraded Broadcom's rating to buy, although he slightly lowered the price target from $275 to $225. $225. Yoshia identified 4 primary drivers that he believes will propel Broadcom forward. These include increasing demand for its processors, strong performance within its networking segment, positive contributions from its acquisition of VMware, and a rebound in its core semiconductor business after enduring 2 years of softness. According to Yoshia, the pullback in Broadcom's stock since its highs in December represents an attractive entry point for long-term investors. Wall Street largely shares this optimistic outlook, with 23 analysts issuing buy ratings and only 2 assigning hold ratings. The consensus rating for Broadcom is strong buy, with an average price target of $250.90. Analysts are forecasting an upside potential of over 71%, making it one of the most compelling investment opportunities in the semiconductor space today. Now let's take a deeper look at Palantir Technologies, a company known for its cutting-edge work in data analytics and artificial intelligence applications. Palantir has enjoyed a remarkable rally over the past 12 months, with its share price skyrocketing by over 229%. This explosive growth has been fueled by the company's strong financial results and the rising demand for its artificial intelligence solutions across both the private and public sectors. However, concerns are beginning to surface regarding potential cuts in government spending, particularly related to programs initiated by the previous administration, as well as worries about Palantir's high valuation. Palantir has shown consistent growth in its commercial and government segments across multiple quarters. Despite these gains, some analysts have questioned whether the company can sustain this pace in the face of broader macroeconomic pressures and geopolitical challenges. Investor concerns have been amplified by a wave of insider stock sales, which some view as a red flag regarding internal confidence in the company's long-term trajectory. In a recent analyst note, Brent Thill from Jefferies reiterated a sell rating on Palantir, setting a price target of $60. Thill acknowledged the positive impact Palantir is making, especially as evidenced by return on investment case studies showcased at its 6th Artificial Intelligence Platform Customer Conference. These examples demonstrated how Palantir's software is helping to drive operational transformation across industries. However, Thill also pointed out that much of the excitement surrounding the company's prospects has already been factored into its current stock price. He noted that with a price-to-earnings ratio of 45 times expected earnings for the year 2026, Palantir is currently the most expensive stock under his coverage. The analyst also highlighted the significant level of insider selling as a potential risk for shareholders, suggesting that some insiders may believe the stock has peaked. On Wall Street, the sentiment surrounding Palantir is more mixed. The stock holds a hold consensus rating based on 4 buy ratings, 11 hold ratings, and 4 sell recommendations. The average price target of $92 indicates an expected upside of approximately 24.3%. In the end, Microsoft, Broadcom, and Palantir Technologies each offer unique investment opportunities within the tech sector, despite facing headwinds such as global trade tensions, economic uncertainty, and intensified artificial intelligence competition. Microsoft has declined over 15% in 2025 due to cloud growth concerns and AI spending, yet analysts remain optimistic due to strong fundamentals, expanding margins, and a growing AI business projected to bring in over $13 billion. Broadcom, down 37% this year, is favored for its custom AI chips and rising demand from hyperscale customers, with analysts projecting over 71% upside. Meanwhile, Palantir Technologies has surged over 229% in the past year, driven by strong performance in both government and commercial segments, though its high valuation and insider selling have raised concerns. While Microsoft and Broadcom hold strong by consensus ratings, Palantir maintains a hold rating with a more modest 24.3% upside potential, according to Wall Street. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.